a lot of these founders might be engineers, great product guys, but they don't know the first thing about, raising money or the valuations behind it.
Yeah, absolutely. I mean, look, if you're already getting a term sheet, you're in a good spot, right? You've already succeeded beyond what many, many, many companies are doing. So that's pretty exciting. Pat yourself on the back. And now the numbers, right? So people get really stuck on the headline value. They want a certain number. No, we want to be worth $5 million, or we want to be worth $10 million, or $100 million, right? And that's great, right? Like if you want the headlines to show that and you want that to be part of your press, certain numbers, trigger certain feelings on people. Like 10 million is a nice threshold to cross. But what you really want to be thinking in your term sheet is, what am I giving up, right? So not only what am I giving up that it feels like I'm giving up, right? But what am I actually giving up? So what does that mean? Analyzing, let's call it 3 scenarios. One, your ultimate upside, right? So based on this round, what does it look like on the ultimate upside, and how much of the company did I share? Because if for whatever reason that upside, suddenly you shared 45% of your company, that's not a great outcome, right? Like you shared too much at the beginning.
Yep.
If you have some middle ground sharing where actually you don't make any money because the VC protected themselves so much, that's also not a great outcome, right? Because even though you're shooting for that $1 billion IPO, you might get stuck in $100 million M&A, which again, very successful event, but you may not reap the economics because the VCs protected themselves so much on participation, on liquidation preference, on a bunch of other things. And then the downside scenarios, right? You don't want to work for a company that doesn't succeed, and somehow you're in a worse place than when you started, right? You want to protect the VC in those scenarios, but you never want to be left with owing money or something like that, right? So when you're dealing with notes, make sure that there's no like cash redemption options. There's no way for them to bankrupt you if they have certain rights. I say that the rights and preferences of the raise are just as important or more important than the headline value. And then number 2 is make sure that you're sharing the piece of the pie that you want to share for that stage, right? Because some people get really stingy. They're like, no, I only want to share 10%, but then
Mhm.
it's not really going to be worth it for the VC giving you $1 million, right? They want 20, 25%. They want a big chunk because they are going to get diluted in the future. And so you want to make sure that the incentives are aligned on both sides, right? That somebody's putting money and getting a nice chunk, but that you're not overdoing it and losing, 45% of your company on
Yep.
certain scenarios.